Hello everyone, this is Ikhlaq Khan. Today in this video what we are going to discuss is the central bank. In this chapter, as I told you in the beginning, the whole chapter is divided into two main parts. One was the commercial bank and the second is central bank. In commercial bank we have discussed the meaning, its functions, and we have discussed the concept of credit creation and the concept of money multiplier. In this what we are going to discuss is the central bank. Now what happen in a country or in a big economy, there are number of banks. To control all these banks there is a requirement of one of the apex body, and the apex body over here is the central bank. So central bank is an apex body that controls, operates, regulates and directs the entire banking and monetary structure of the country. So in this way, central banks means the apex bank of any country. In case of Central Bank of India, it is RBI. So central banks means the apex bank. What functions they perform, why they are made? They are made to control, operate, regulate and direct the entire banking system and monetary structure of the country. Let us move the case of India. India Central Bank is the Reserve Bank of India, which is known as RBI, Reserve Bank of India. RBI was established in April 1, 1935 under the Reserve Bank of India Act passed in 1934. There are chances of 1 mark question from this, that the dates the RBI was established on April 1, 1935, Reserve Bank of India under the RBI Act 1934. Let us move to next topic, functions of central bank. In now, as we all have discussed, what is central bank? A bank, apex body which controls, operate, regulate and direct the entire banking system. In case of India, it is RBI. Now we will see the functions of central bank. In any country, there are certain important functions the central bank performs. In case of India, let us see. The first function is the currency authority, which is also known as bank of issue. Central bank is the authority, is the bank have sole authority of the issue of currency. All the currency except 1 rupee coin and note. Why 1 rupee note and coin? Because 1 rupee note and coin, it is issued by the government of India, the finance department, government of India. Apart from this 1 rupee note and coin, every other currency and authority is issued by the other banks and not other bank, by the central bank of. So the currency authority of bank or bank of issue, all the currency issued by the central bank is monetary liability. That's why central bank is obliged to back the currency with the assets of equal values, enhance the public confidence in the paper currency. Means, as I told you, the currency authority means the central bank has authority to issue the currency except 1 rupee note and coin which is issued by the government of India. Remaining all denominations of money are issued by central bank only. But central bank has a liability. It is not just an asset. Monetary liability, central bank, it is the responsibility of central bank that monetary liability, central bank is obliged to back the currency with assets of equal value. Means, suppose if they are printing 10,000 crore, then they are supposed to keep 10,000 crores value of assets to enhance the public confidence in the paper currency. Assets can be usually in form of, these are the form in form of which assets can be there. It can be gold coins, gold bullions, foreign securities and domestic government local currencies securities. So any securities can be there. It can be security in form of gold, in form of securities. So in this way the currency authority and bank of issue function is there. Then there are certain advantage that RBI is performing this function. What are advantage? First, this uniformity, as there is sole authority, single authority of function, nobody else is there who is printing the currency. That's why there will be uniformity and advantages in the functioning of this. Next advantage is the power to influence money supply. that RBI as is the currency authority, then they can influence the money supply, means they can control the money supply. In this chapter only we will see this topic clearly later on. Then supervision and control of the other functionings, ensure public faith, that public will have faith that yes, it is printed by RBI only. Help in stabilization of internal and external value of currency. In this way, this is the advantage of currency authority function being performed by RBI. Later there is one more function which is performed by RBI, is the deficit financing. Now the word deficit financing, central government borrows from central bank. Central government, the Union Government of India, borrows from the central bank by selling its treasury bills. When central bank acquires the security, it issues new currency. This is known as monetizing government debt or deficit financing. What happens whenever there is a excess of government expenditure and less government revenue? So in case of excess expenditure and less revenue, there will be a situation of deficit. So in case of deficit, government need to recover this deficit. And how government can recover this deficit? By taking money from RBI, and the process through which RBI recovers, give financial help, monetize the government, is known as deficit financing. So deficit financing is a concept where government took money from the RBI in order to meet the deficit in its budget. Then next function of RBI is the bankers to the government. RBI is banker to the government. As in deficit financing only we have seen that in case of loss from anywhere where government is borrowing the money, government is taking from the RBI. In this way, bankers to the government. RBI perform the function of the banker to the government. The Reserve Bank of India act as a banker and as a banker, agent and financial advisor. Three function: banker, agent and financial advisor to the central government and all the state government. So these three functions performed by central bank towards the government. First, as a banker, what function central bank perform as a banker? As a banker, maintain current account of and their cash balance of the current account of the government and their cash balance, accept receipt and make payment for the government. Then deficit financing, because a central bank does not deal with general publicly directly, it deals with only commercial banks and it deals with the Government of India. So for Government of India, as a banker, it maintains the current account with them, cash balance, help in deficit financing, help for receipt and payment of the government. Then as an agent, what function as an agent they perform? The central bank also has the responsibility of managing the public debt. Whatsoever public debt is there, central bank is there who is managing it. Then as a financial advisor, central bank perform this function also. Central bank advise the government from time to time on economic and financial monetary matters, because government is not that much efficient, though government have finance department, but the finance department is not that much efficient and all. It's the RBI, the authority which have complete knowledge of the economy, the money supply in the economy and the monetary policies to be followed within the country. That's why as a financial advisor, government used to take advice from the central bank, RBI, and on the basis of RBI advice, government used to function. So this is the next function, bankers to the government. Under bankers to the government, we have seen how they are performing these three functions: as an agent, as a bank, or as a advisor. Moving forward, the next function performed by the central bank is the bankers bank and supervisor. Not only government bank, but central bank is the bankers bank, all the bankers bank and the supervisor. RBI, being the apex bank, act as the supervisor and regulator of the commercial bank. So there are number of commercial bank in our country. All these commercial bank, they are controlled by and regulated by the RBI, that we have seen in the definition of RBI only. What function they perform under this? Under bankers bank and supervisor, the first function is the custodian of the cash reserve. What is cash reserve? All the commercial banks are responsible and they have to keep a certain amount of their time and demand deposits with the RBI as a security, which is known as cash reserve ratio. Cash reserve ratio is the ratio of total time and demand deposits in form of cash kept by commercial bank with the Reserve Bank of India. So cash reserve ratio is the portion of deposits commercial bank keeps with the RBI. That's why custodian of cash reserve function. Second, lender of last resort. What happen, even commercial banks are sometimes facing crisis and all. When they face crisis and if there is nothing, no source is there to get help, then it's the last source to take loan. So commercial bank get help from the Reserve Bank of India, and they can get help from Reserve Bank India through discounting of approved securities and bill of exchange. By keeping this bill of exchange and approved securities are there, by keeping this security with Reserve Bank of India, and commercial bank can also get money. Then clearing house, this is important, another important function that central bank of our country perform for commercial bank. Clearing house means all the commercial banks have their account with the central bank. Whenever there is a problem of payment and all, at that time central bank helps to clear it, as central bank holds the cash reserve of all the commercial bank. Also, apart from bank account, central bank have cash reserve from every bank of all the commercial bank. It becomes easier and more convenient for it to act as their clearing house. RBI can easily settle claims of various commercial bank against each other by making debit and credit entries in their account. What is the necessary? So in this way, central bank also performs this banker function. So in banker functions, I hope the concept is clear to you. Bankers bank or the supervisor, these functions are the function as a banker, custodian of cash reserve, lender of last resort, clearing house. Then RBI as a supervisor also, what function as a supervisor they perform? They perform regulation of banks related with the supervisor. So supervisor means licensing policy, branch opening, branch expansion, liquidity of asset, merging two banks or winding up banks. So this is the supervisory function that Central Bank of India perform. Let us move forward. Next is the controller of the money supply and credit. RBI perform this functions, which is one of the very important function. What is this function? Controller of the money supply in the economy. We have seen money supply in the chapter of money. What is money supply? Then and credit. So RBI controls the money supply in the economy and the credit. How it controls? RBI follow one policy which is known as monetary policy. Monetary policy adopted by Central Bank of Economy in the direction of credit control and money supply. There are certain instruments under monetary policy through which RBI controls the credit and money supply in the economy. What are instruments under money supply? Let us see. The first instrument is the repo rate, which is also known as repurchase rate. Then there is one more rate which is known as bank rate, repo rate, bank rate, then reverse repo rate. These are the functions that they perform. Then banker to the, let us see this first, repo rate. Now under instrument of monetary policy, there are certain 4 and 5 major instruments. For this video we will discuss the 3 instruments. First is repo rate, which is also known as repurchase. RBI lends money to commercial bank. When RBI lend money commercial bank for short term needs, say for a need of 1 year in a short term interest rate, so this is known as repo rate. Repo rate is the rate at which the central bank of a country, RBI, lends money to commercial bank to meet their short term needs, is known as repo rate. There is one more rate which is known as bank rate. So bank rate is the rate at which RBI lends money to commercial bank to meet their long term needs. So there is a difference between repo rate and bank rate. Repo rate, the rate for short term needs. Bank rate, the giving loan by RBI to commercial bank for long term needs. So I hope this concept of repo rate and bank rate is clear. Now how with the help of repo rate and bank rate RBI controls the money supply? Because we are discussing this under controller of money supply, monetary policy. So what happen when they rate at which they are giving the loan to commercial bank? RBI if increases an increase, let us see this, an increase in repo rate. If the rate at which RBI giving money for short term to commercial bank, an increase in repo rate increases the cost of borrowing, because cost of borrowing will be high. Suppose if the repo rate at present is 4%, if it is say 4%, means if 4% interest rate means if 1 crore or one whatsoever amount is there which commercial bank is taking for short term needs, they need to pay at an interest rate of 4%. If RBI is increasing this interest rate now say 6%, then it will be costlier to take loan from RBI. As it will be costlier to take loan from RBI means it force commercial bank also. It force commercial bank to increase their lending rate. Then commercial bank who is taking money from RBI, they will also give loan to general public at a high rate, which discourages borrowing and taking loans. So general public will not take loan because the rate will be high. So in this way, to control the money supply and the credit in the economy, there usually RBI used to do the fluctuation in repo rate. So in order to decrease the money supply in market, what RBI will do? RBI will increase the repo rate. As the repo rate will increase, so for commercial bank it will be costlier to take loan from RBI. It will be costly for commercial bank, then commercial bank will also increase the lending rate. So it will be difficult for general public to take loan. So it will discourage the loan borrowings. And if in case RBI wish to increase the money supply, so vice versa they will do, means they will reduce the bank rate, repo rate. If they will reduce the repo rate, so when they will reduce the repo rate, what will happen? It will be cheaper to purchase loan or to take loan from the RBI. And if it will be cheaper, then they can easily then they can also reduce the lending rate. I hope the repo rate concept is clear. The same concept, this concept is applicable in the bank rate also. As we have seen in bank rate, the rate at which RBI gives money for lend money for to meet the long term needs. So bank rate has the same effect that of the repo rate. As we have seen in repo rate, to increase the money supply, repo rate will reduce. To decrease the money supply in economy, repo rate will increase. The logic is clear to you, I think. Then the same with the bank rate. To increase the money supply in the market, RBI will reduce the bank rate because it will be easy to take loan. And to reduce the money supply in the market, if there is excess money supply, RBI will increase the bank rate. I hope the concept of repo rate and bank rate is clear to you. Bank rate is known as discount rate, whereas repo rate is known as the repurchase rate. Let us move. There is one more rate which is known as reverse repo rate. Now repo rate and reverse repo rate, it is just opposite. What is repo rate? At which RBI gives money to commercial bank. Sometimes commercial bank have excess money with them, the surplus money. So commercial bank, what they used to do, they keep this excess money with the reserve bank. When commercial bank is keeping excess money with the reserve bank, then reserve bank will be giving loan. That's why it is reserve bank will be giving interest. That's why it is known as reverse repo rate. In case of repo rate, commercial bank is giving interest to RBI, but in case of reverse repo rate, RBI is giving interest to commercial bank. Rate of interest paid by RBI to commercial bank because of the surplus deposit kept by commercial bank with the RBI. So when the RRR means the reverse repo rate is raised, it encourages the commercial bank to deposit their funds with the central bank. Why? If RRR is increased, reverse repo rate is increased, means the RBI is giving more interest. If RBI is giving more interest, so it will encourage commercial bank to deposit more with the RBI. And if commercial bank will deposit more with RBI, this has the negative effect on the lending capacity of the commercial bank, because most of the money commercial bank is keeping with the RBI. As they are keeping with RBI, so they will have less money to lend to general public. Lowering the reverse repo rate has the opposite effect like this. So I hope the concept of repo rate, bank rate and reverse repo rate is clear to you. By the next video, there are some more functions that we will discuss. Thank you very much. Have a very nice day.